Connect. This is our final series of this term, and raising finance top tips from industry experts. We've been running now Enterprise Connect for about 21 months, and participations continue to grow, and we've had over 4,000 registrations now to Enterprise Connect, and we've gotten some stellar presenters tonight. I'd like to introduce our first speaker. We're really lucky to have John Moulton with us this evening, who's heading up Better Capital, as well as the chairman of FinCap and also the Channel Islands Securities Exchange, having had a long history in private equity and finance in a range of size of businesses, from the small to the very large. And we look forward to comments he can provide to us tonight.
So I want to talk about the difficulties of investing in private companies. I'm mostly an angel investor, and I'll be talking about how it looks from that side of the table. Most of you can work out what it means the other way around quite quickly. Particularly like the one of the two toilets there. It's a real demonstration of innovation. Right. My credentials: I've been 34 years in the professional private equity trade. I've written off about 30 companies for a total which I'm afraid pushes towards $500 million. So I am definitely not infallible, so don't take everything I say as right. There's been at least 50 deals which, when I look back, I know I could have done better at. So a lot of experience, but actually decent return overall. Certainly a hell of a lot better than sticking your money in Royal Bank of Scotland stock. And I've done, and I currently have about 100 personal investments, angel investments, mostly in quite early stage companies, where I lose about a third of the capital that I put out. So when I start talking about what you can do wrong in investing, believe me, I know a great deal about that. Don't give refutable arguments. Give real honest answers is the right thing for an angel to do. It isn't very often done. People don't like to have that happen. But you can waste a lot of time. And here's another way. How many business plans are achieved? Short answer, I haven't seen one, ever. Projections are normally little more than an exercise in mental masturbation, where numbers are chucked out which are never achieved. Reading a full business plan and the detailed projections with it may pass time, but it has no other merit. The real art is picking out the important stuff and reading that. If you get it generally right, you've done brilliantly. To expect that you'll get it accurate is impossible. Don't spend money on legals till you've got a deal in sight. When somebody said we'll do 30% of the company for 300 grand, then start the legals. Not start the legals and find out you haven't got any investors on the terms you imagined. Not doing enough time to look at things, even though you can do things quickly. You can also be guilty of great superficiality. I've certainly done this many a time. Failed to actually follow through on a few things that I could have done with 10 minutes on Google, or just a good sensible telephone call, but always allow at least enough time. I always give declines in writing. FOSB is shorthand for what I give my secretary to type, and the last bit is stop bothering me, but you can work out the rest. Good documents help a lot in investing. So not vast business plans, short, intelligent summaries. Might only be PowerPoints. That's what sells an investment, not 55 pages of closely typed stuff. My favorite ever business plan arrived with 7,000 pages. And then a week later, as we stared with disbelief at the two boxes of paper, arrived another package of about 50 pages headed errata. Funnily enough, didn't invest. Always allow enough time to do it, but do it quickly. Putting money into a way overvalued company at the start just guarantees the dooming of the company, actually, because there won't be any investors later, and nobody makes any money or any fun. So investors should get a decent return. Back to that EIS point. Investors expect to make 3 or so times their money in investing in unquoted companies. That's because they lose the money probably half the time. So if they do a lot of them, they'll end up making 1.5 times their money, which is a pretty miserable rate of return over time. There are very few angels who do that well. Very few. Most angels lose money. Never rely on the projections because they're never met. So, you know, it's going to make 7 million in year 5. Probably be lucky if it makes $500,000. Control's important, so who's the controlling shareholders? And remember, screwed investors don't reinvest. You can only screw them once. People don't get screwed 2 or 3 times very often. Investors always overvalue brand names. That's fascinating. Sometimes to my advantage, and Julia'd certainly know it, if you get a notable angel in as an investor, other people pile into it because they must know what they're doing. Might be worth a bit, but it's never worth what people imagine. Optimism, investors and advisors, optimism is nearly always a mistake. The future doesn't belong to the optimists, it belongs to the survivors. Remember that. There's no solution to optimism. But it may be essential to actually operate in this kind of area, so you've got to do it. Questions I think I'll probably leave to the end because I've overrun, but there's another satisfactory toilet layout. Thank you very much indeed.
I'd like to introduce as our next speaker, Carlos Eduardo, who co-manages Seedcamp, and prior to that was a venture capitalist, mainly in the tech space. And you can speak with us.
So fundraising is something that's changed over the years. When we started the Seedcamp program back in 2007, it was something that was the reason why our investors are all investors themselves was because there was this gap in funding. And so we provided capital for this gap. We provided, back in those days, we provided 50,000 euros of financing for companies that were like 2 guys in idea leaving college and wanted to start off. The cost for startup creation has severely declined over the years, severely declined. And, you know, whether everything is now cloud services and the like, the biggest problem now isn't so much the cost as much as it is getting the interests of the John Moultons of the world and the Jimmy Meyers of the world for the next round of financing. And that now has been pushed higher and higher because there are so many startups that are being put out in the market right now, and a lot of the money that's being unlocked has basically piled back into startups that are kind of in that early stage because of SEIS taxation. I won't go into that too much, but the money that is required to grow a company after like the sort of 2 guys an idea is increasingly being very, very selective about who they're backing. So that's why I start off with this slide saying fundraising is a journey, because you know what? The more you get yourself into this mindset, the less frustrating it will be. I'm not saying the frustrations will go away, but definitely it's something that we work with our founders to understand. And what I want to talk about is a little bit of the types of investors that you'll meet along the journey. And as I said, this is a little bit of a tongue-in-cheek view. I think John covered a lot of the types of investors that you may or may not want to meet. So, first of all, you'll have investors who doubt your ability to execute. I was in a board meeting, well, rather a partner meeting, reviewing an investment deal of a company you all know, where the partners involved were discussing the capability of the executive team in delivering. Now, of course, I can't tell you which company it is, but I can tell you right now it's very successful. And the conversation happened about 5 years ago, 6 years ago. So the company now has proven its chops. At the time, the partnership thought that these founders needed to be replaced with some guys who were wiser, older, more experienced, parental supervision, if you will. And it turns out on intuition that by having left the founders in place, these guys kept the culture of the company, and they learned quickly, and they really made the culture and the brand what it is today. So just to give you a view on that, don't necessarily underestimate yourself, but people will definitely underestimate you. Some of the best introductions that I've received as an investor and other investors have received are from other founders they respect. So if you become friends with like the tier 1 founder from another company that investor wished they had invested in, getting that recommendation is huge. So put yourself out there. So connections come from the least likely of places. As I mentioned before, make sure that when you're trying to reach an investor, you go through a trusted third party. It just does marvels for opening doors. So get out there and meet the right people. We touched upon this earlier, being a good storyteller. Now, there's this phenomenon. How many of you listen to podcasts? Okay. So there's a great podcast I recommend you listening to. It's called Startup. And it's the story of I forget the name of the column he was writing for. He's a well-known New York Times columnist or whatever. And he decided to quit his job. And he decided to quit his job to start a startup, and he was going to document the entire process on a podcast, because what the startup he's creating is a directory of podcasts. It's kind of meta, right? And so what he decided to do is that he's going to go through the entire process of fundraising as part of the entertainment value of the podcast. So the very first podcast is how not to pitch to a billionaire. And so he goes to pitch to Chris Sacca. Do you guys know who Chris Sacca is? Okay, Chris Sacca is the investor in Twitter. Let's just say he's loaded. So he goes to pitch him, and he's got the microphone on, and you can hear him pitching his company to Chris, and makes every mistake possible. And then Chris pitches his company back to him and says, look, it's about creating a fear of missing out in an investor. At the end of the day, it is a little bit about being a good storyteller, but intrinsically, with as many options as investors have, you basically have to do a great job of convincing them that if they do not invest in you, they have just missed the biggest ticket in the next Twitter. And you have to go on several dates. The record, I was actually in a board meeting today with one of our companies who has the record for most no's before a yes. And I think it was 86. 86 no's before a yes from an investor. And the company's doing fine now, and it's actually growing quite well. But it was actually on a meeting where the investor he was meeting forgot that he was meeting him. And the investor said, okay, get in my car, we'll have a chat. So they're driving, and he said, tell me what you're doing. Guy tells him what he's doing. It's like, all right, I'll invest. That's all it took. But it took 86 no's to get there. So 4 takeaway lessons. It's a journey. It's not going to be without hardship. As long as you get into that mindset, it'll be a lot easier. Embrace rejection as part of that process and learn from it. Don't take it as a personal rejection. There's nothing wrong with you per se. It's just maybe that moment. What did you do wrong? Treat every meeting as a form of practice. Everything, write down everything that went wrong, that you think went wrong, or feedback that you got, and be iterative about it. Sometimes we recommend our teams A/B test things. So if you have 2 meetings following that one, and you weren't undecided about how to present this or that, just go back and forth. Present one, and then present the other one at the next one and see how it gets on. And lastly, analyze what was said and improve on these mistakes. Was it Einstein that said, it's only an idiot is the one who does the same thing and expects different results? So with that, thank you.
Just to introduce Julie. Julie Meyer is founder of Ariadne Capital, and a long association with trying to foster and help entrepreneurs build tech, angled, and defining sector technologies. So we welcome you to talk.
I wanted to first of all give you an invitation to go to Entrepreneur Country, which is this fictional world that I created. As we were going into the financial crisis, I remember saying to myself, first of all as an entrepreneur, but second of all as an investor who works with a lot of entrepreneurs, that there were all sorts of people in the system, like the greater system of life, that I felt should go to Entrepreneur Country, where entrepreneurs go every day, because people who are running their own business, frankly, they deal with all of these pressures every day that the average person in the street really can't understand at all. There's just some people would think it's a kind of maybe, 1 to 3 differential between the pressure that it takes to run your own business, deal with payroll, banks, products, people, you name it, customers, all the rest of it. And I just felt that if people could just stand in the shoes of entrepreneurs and deal with that every day. And so what I decided to do was to create a place where the entrepreneurs go, because it's a safe zone, but then to issue an invitation to the world to go there as well. And I'm going to tell you a little bit about why I think that's important by taking you to Entrepreneur Country tonight. So I'm going to give you quickly 3 visions of the future. And ecosystem economics is our investment methodology, and that's really what this is all about for me. You want to raise finance. I'm going to give you a pair of glasses for how we look at investing today as we go into 2015. So these are the 3 visions of the future. The first vision is really that the U.S. mostly, technology platform companies are going to take over every industry. And there's some big companies there. There's companies like Apple, Amazon, Facebook, and Google. And there's a lot of evidence that they intend to take over every industry. And if you just read the newspapers, you could kind of think that maybe, you know, they're dominating all of the big deals and the news and so forth. The second vision of the future is that they're younger brothers, these kind of digital Davids, the big disruptive forces that are creating the new established giants. So those are the Airbnbs, the Ubers, the Teslas, and so forth. And these are the men and the women that have raised hundreds of millions, if not billions of dollars. They're telling a big story to the market. We're going to disrupt, start all over, create a whole new whatever industry. And if you go to Silicon Valley, you get big time Vision 1 and Vision 2 of the future. The problem with that is that 95% of the universe is not included in either one of those visions. The kind of 9/10 of the iceberg which has not, quote unquote, gone digital. And that's where I think it gets interesting, because the third vision of the future is for the rest of the world. It's for people who have a stake in the existing system, the existing banks, the existing insurance companies, the existing retailers, everybody else who's out there, which is not in version 1 or version 2 of the future. And that's where I think it's important, if you are raising capital, if you're building your business today, it's important to understand that it's not just about what you're trying to get to market. It's about understanding how that fits into the larger context and the larger kind of macro thing which is going on. But I want to focus on this guy who's not just the face of Virgin Media. He's really the face of every entrepreneur. And I never forget, we see about 100 companies every month at Ariadne Capital that come in to get finance from our venture capital fund. And I never forget that that's the face of every entrepreneur. And indeed, it's probably my face too. The more you tell an entrepreneur that he or she can't do something, the more they're thinking to themselves, you just keep on telling me that and I will show you, right? And it's important to remember that that's what drives really good entrepreneurs, is this need to demonstrate and to impose themselves on the world, right? That's one of the biggest drivers for entrepreneurial success later. But Europe in general has not created platform companies. So platform companies tend to be where all of the economics are going to right now. Those are those Apple, Facebook, Amazon, Google that I mentioned earlier. And for lots of different reasons, Europe has not created a number of these platform companies. But there's a big opportunity for every corporate to become a platform. Not every, but most. Car companies are becoming platforms. Media companies, retailers, banks, insurance companies. But that transformation is going to be long and arduous, and it's going to be fraught with a lot of failure. But the platform companies are where the economics are basically controlled. What does Google, Facebook, Amazon, or Apple? What's the key to their success is that they control the economics of their ecosystem, right? Google say that they organize the world's information. Actually, they do a lot more than that. They organize the economics of the world's information. Why was Apple able to move the music industry to Macworld? Is because they created clear economics for what happens in the music transaction, in the same way as they're doing with Apple Pay, right? It was a dinner earlier this week with a bunch of banks, and they were all concerned about what Apple Pay had done, but they're failing to learn the lessons from what Apple did last time around, right? So the banks used to control the networks, and now Apple has come in and said, I think we'll just make a set of really clear economics because we've got a lot of consumers who come to us. So we've got our leverage there. And so we're going to take a cut of these transactions going through the banking network. It's always about the economics. So the platforms are where the corporates need to get to. If they're infrastructure companies, they need to migrate up. And many of you will be setting up application companies, digital startups of various types, and you'll be wanting to engage with very friendly and open platform companies, not just the app stores, but many of them that are here. The number one thing to do in having those discussions, which will help you with your fundraising discussions, is to focus on how you can bring revenue to those corporates, to those Goliaths, right? So if you're having a discussion, it could be with, I don't know, Paddy Power, Santander, Aviva Insurance, whoever it is. It's talking about how you can apply your business to their distribution and help them build a digital P&L. So I'm going to stop there. Like I said, I'm happy to share the slides. I hope that you become a citizen of Entrepreneur Country because you'll get more opportunities to learn more about our particular take. And thank you. I'm happy to take your questions later. Thank you.
Okay, I'd like to introduce Nigel Verdon, who's founder of the Currency Cloud and has a lot of expertise in backing financial sector startups. For you to talk to us.
Good people generally get backed more than good ideas statistically. And the risk profile of the investor who will invest in the seed area is a very different type of animal who will invest later on. So what you also need to do is find and select the right people with the right sort of mentality and the right approach who will invest in seed capital. And I'm just going to repeat a couple of things. One of the things is make sure you're all in the same game. So the concept of share classes, you've all got the same share class. Anybody who comes to you and said, I want preferred shares, I want all X, Y, and Z rights, etc., they're not a seed investor. They're not aligned with you. You've got to create the concept of a coincidence of purpose, especially at the seed side. So there may be a very famous guy and he's put all his rights in, walk away from it. The guy is going to give you the right share, but same share class, you're all on the same team together. It's very, very, very clear. Otherwise, later on down the line, you will devalue your business. Other investors won't come in as well. Once you've got your idea, your seed financing, your selected investor who's very good at seed financing, and you've got the right, you're working together as a team, etc. The next sort of stage you have is you're making a product. So you need to start selecting an investor who's very good at providing you the ability to understand product and what product's all about. So if you're raising finance at the product stage and somebody's asking for a 5-year plan, even a 3-year plan, that's always wrong. Every single plan you put together is wrong. If you're putting pages and pages and pages of business plan together, don't at all. Work very clearly on what the story is about your product, what your product's going to do, what it's going to change. And if I'm personally investing in technology or fintech companies, I look at what dramatically does it change in the process, doesn't improve it, but dramatically does it change in the process, that product. That's what you're really interested in. So if you ask questions, 5-year plans, you ask questions that aren't really related to your product, they're asking about how you're going to scale your business, etc. At that stage, the product stage of business is not the right investor. So qualify them out. Other things I've learnt along those sort of different pieces of raising money is there is an awful lot of guys who will waste your time. And they'll waste your time for not being bad people or anything like that. They'll just waste your time because they won't make a decision. They won't say to you straight up, I don't really invest in this area, I'm not in the right stage, I'm for the next stage, and make a lot of excuses. And just be prepared for that. Don't get frustrated by it. Finding guys who are entrepreneur friendly is difficult, especially in the UK. In the US, because there's a lot of ex-entrepreneurs in the funds themselves, they tend to be more entrepreneur friendly because they understand the issues, etc. The UK, a lot of the money tends to be run by general finance guys, ex-investment bankers, etc., etc. I'm an ex-trader, so that's where my cynicism comes from. But the money tends to be less entrepreneur-driven and more finance professionals driven. So they tend to be less entrepreneur-friendly. There are corner cases, there are funds that are very good, but try and look for somebody who really knows and understands the entrepreneur and the motivations they go through to try and be successful on that. Lead investors are very important if you get the right lead guy who understands, is entrepreneur friendly, is aligned with the stage of business is at, because they will draw in the sheep. There's a lot of sheep money that will just follow a guy like from Atlas or from Axel or something, or Bullet on the good funds, and they will bring the money in. So don't get too hung up. You need a round of, say, 5 million sterling or 10 million sterling. The lead guy puts in 2, the rest of the fund, the rest of the money will come in because there's a lot of sheep money. And when you get a sheep taking lead, I would question it and just walk away to try and find a decent lead. So real skill is finding a quality lead investor who will bring the sheep money in. Meddling, over-meddling on the board for non-entrepreneur friendly investors is a real pain for a lot of companies, especially entrepreneurs. You've got to be disciplined to give your numbers and everything, and I certainly subscribe to the accounts have to be out every quarter and every month for your investors. That's not meddling. It's when they're trying to be operational and run your company. That is very, very dangerous if you have somebody who thinks of operation. They're an investor, which is a very different role from an operational guy who's to get it done. They're investing in you to be the operational guy. Now, if you don't hit your numbers, you don't perform, etc., there's good reason for them to remove you because you're not the operational guy they're investing in. But the investor becoming an operational guy is quite dangerous and can be quite toxic to your company. So just be aware of that. Now, just philosophical thing. I've always found it's just trying to get coincidence of purpose. Sometimes you've got to give a bit more away to get an awful lot back. I was taught by a wonderful chap who was on the board of BP, chairman of Eurotunnel and various other high-profile jobs in his life. He always just said, just create coincidence of purpose. And when I was a trader, it's the same thing. You always left a bit in the deal because when everything went wrong for you and trading, everything goes wrong occasionally, somebody else is able then to help you out because you've always left something in for somebody else. So always create coincidence of purpose. Never go into trying to screw the guy all the way down in a deal or transaction because it will never work out in the end.
I think I heard you say why crowdfunding is a bad thing. Yeah. Crowdfunding isn't a bad thing. It can be a bad thing. If it's done really, first of all, there's debt crowdfunding. I think that's actually relatively short of vices. Standard documents, pretty well understood, standard disclosure, standard processes. Investors can invest in that relatively easily. When you start talking about investing small amounts of money from a very large number of investors into the equity of an early stage company, you've got all kinds of issues start to pop up. You're probably not going to be in any position to negotiate legals, so the legal protection going into the deal will be very slight. You probably will not get warranties. You probably will not get transfer conditions that appeal to you. You will not have any ability to stop the CEO paying himself a fortune and swiping all the money out of the company.
I'm going to say that companies can fall into one of 2 buckets. Call it negative bias and positive bias. Positive bias is a company that is hot right now. Let's say fintech is hot right now. That means if you come up with an idea that has to do with disrupting financial services, most investors will take a look at you. Now, if you come in with yet another photo sharing app, in the wake of Snapchat, in the wake of Instagram, in the wake of all these things, it just becomes that much harder. And so, unfortunately, and I'm going to, kind of put my neck out there, there's a lot of apps out there that have to do with sort of relational building. And the problem there isn't so much whether it's good or bad, or it's intrinsically worth a lot more. It's just that there's investor fatigue. So the best thing that you can do is find the investors that are very interested in that unique space, like that very divided space. Events like these are important in helping people get inspired, both in terms of their ideas not being necessarily something that couldn't be done because you'll hear how other people have done it, but also in getting a good feeling for how the investor thinks and how it is that they evaluate a company.
Frankly, one member of the audience decides to do a startup because they've been here tonight, it will be a fantastic success. It will generate a lot of jobs and a lot for the economy. It may well do a lot more than that, but that's all it needs to do, and I think it's got every expectation it'll do that.